All right. This is Eric. We're going to get started. We are going to record this session and send it out to you. You'll have it access on the website. So if there's things that you didn't catch and you want to catch later, feel free. And plus, we certainly want to make it available to everybody. So we appreciate everyone taking their time. We are very excited, speaking from the entire Hilltop team, about some of the enhancements and upgrades that we have made to our investment models. I just want to take you through kind of our process that we've been through over the last several months, many months, and then I'll introduce Chris Schuba and let him kind of get into the details. Our investment committee for some time has really been wanting to just have an enhancement within our investment models and what we provide to clients. We thought we had good models, we had good basis for our decisions, and felt that they had done well. But we also felt like with continuous economic conditions and potentially rapid changes within the economic conditions, we could even do better. Our investment committee did a due diligence process, and so we interviewed several firms that provide and partner with firms like ours in guiding and direction. We really had two choices when we were thinking about this, and we felt like going to outsource and bringing in someone that has just a wealth of experience was the best decision, and we've landed on Helios. We just want to make sure everybody can hear us. If you can hear us, if you can type just yes or something in the chat bar, there is a chat there that you can type yes in. That would be great. Very good. Thank you very much. And also in the question and answer, so you can throw us a question and answer. Question, and we'll answer. So if you have questions along the way, please do so, and we'll try to answer some of those questions as well. A couple things I want to point out, and then we'll let Chris take over. The first thing is that these enhancements do not increase your asset management fees. So we really want to make that clear. This wasn't something that was really ever even thought about. This was about enhancing the current experience that you have with us and at Hilltop. Secondly is we actually will find that it will actually reduce costs on many of our portfolios because of the type of structure of investments that we're using. Exchange traded funds, low cost mutual funds, and so forth. So no cost increase. We did implement a lot of the changes last week. We sent out many communications about it, so you would have seen some of those changes potentially in your portfolio. And what's really important to understand is this does not change your risk tolerance. So whatever your risk tolerance is with your advisor that you've agreed upon and you're comfortable with, this is all within those risk tolerance discussions. And so we're just happy to bring that to you. So Chris and I met several years ago. I think he'll talk a little bit about that. And I was intrigued and or impressed at that time, and had really kept it in my back of my mind, saying that, you know, there would be a point in time maybe where this would be appropriate. And as we went throughout the last several years, and as I said, you know, we've had some market swings. Some of the strategies that we were using, we felt like just needed to be enhanced. Chris and his firm, Helios, was one of those firms that we did due diligence on, and here we are. So Chris, I'm going to let you take over. Chris is the CEO of Helios, and it is great for you to join us today. And again, if you've got questions along the way, I'll kind of be monitoring those, and we'll be glad to take them. So Chris, it's all yours.
All right. Well, thanks so much for having me. Hopefully my audio is coming in loud and clear. I'm excited to be here. Yes, I am. I'll do a little bit of background here just to get everyone comfortable with with Helios. But today's about having a little bit of fun, just talking about the methodology that we deploy, the type of research that we provide to Eric and his investment committee. As Eric mentioned, he and his team still maintain total and complete control over all of your portfolios. We simply provide research and analytics to help them, make more consistent and confident decisions as it relates to your portfolio. So just wanted to kind of share that up front. A little bit of background on us before we dig into methodology and maybe talking a little bit about market expectations. Our pedigree goes back deep into the institutional space. But by 2013, enough retail financial advisors had started to ask, well, what are all of these different types of strategies that typically had only been available to, endowments, pension fund, ultra high net worth investors? And so by 2013, I decided to leave the institutional space, and most recently with Columbia Threadneedle, who many of you may know is a large mutual fund company, and go to work for a large retail advisory practice, in this case, WGG Wealth Partners. Now, I bring this up only because they are an Ameriprise team. And back then, Eric was also affiliated with Ameriprise as well. So Eric and I met going back to 2014. So 7 years ago is when Eric and I first met. We had dinner together as part of a large group, and we'd really kept in touch since then. But when I left the institutional world and moved into retail, we always thought that there might be a deep solution here that advisors could plug into. And so in 2016, it really made sense to rebrand all of our capabilities into Helios and begin serving a wide range of advisors throughout the industry. Our function in the industry is something called, or what's known as an insourced CIO. And just like every other business that's out there, everyone should have a niche, a specific goal that every company is built around. And that goal for us is very, very simple. It's about maximizing the probability of achieving long-run financial plans or goals. So as we dig through a little bit of our methodology here, you're going to see this come up over and over and over again. How do we make probabilistic decisions to help achieve long-run goals? Over the course of the last 5 years since our rebranding, Helios has grown to influence more than $30 billion in assets, primarily here in the United States. And we have more than 40 employees and contractors on staff doing research and analytics all day long. I'll show you our little slide here. That's me on the far left-hand side, except now I've grown my COVID beard. But this is our group of folks that spend all day, every day, for the most part, on the research and analytics side of our business. My standard joke here is that this is basically what a bunch of guys who never got a date in high school look like all grown up. But be that as it may, we've all worked at some fantastic companies in our career. We've all been to some great schools. And this is really the team of experts behind Eric and his team doing the research and analytics on everything from economics to markets to trade to inflation. Everything you can name, our group is the one that's providing a lot of the detailed analytics that are out there. So quick introduction to us, maybe some faces to help make this more real. But as I mentioned before, Helios brings an institutional approach to the world of retail asset management. And we get a lot of questions. What does that mean specifically? Well, one of the things that means is it's our job to remove the emotion from decision making. In the institutional world, everything is fact-based. Everything is a quantifiable reason for any decision that gets made. And we do our very best to mitigate any external risks. And believe it or not, human emotion is one of those external risks that, as we look towards long-run returns, we need to make sure that we mitigate as many of those externalities as possible. In order to bring this unemotional process to bear for you, we go through effectively 3 layers of risk management. And this is the research and analytics we're providing to Eric and his team, and they're deploying here as well. So it's a nice partnership overall. So let me dig into those real quick. I know I moved quick through our little background, but I thought we'd get into the meat and potatoes faster than slower. So let me start this off by talking about what we call the 3 layers. Those would be the holdings, such as a mutual fund or an ETF, a model, which would generally go into an account that you have, such as your IRA, And then a portfolio. A portfolio is all of your accounts, right? It's both of your IRAs, both of your Roths, maybe your brokerage account. Your portfolio is everything that you have. And right out of the gate, the first layer of risk management that we help deploy is what we call the diversification of holdings. Now, our industry actually has a very big problem here. And that big problem is that we traditionally rely on methods of analytics that tend to decay over time. Now, there are some very, very good companies out there. One example of a great company is Morningstar. They do a lot of great analytics. If you're a do-it-yourself investor in any way, you've probably used them quite a bit. But the problem we have with inherently backwards-looking analytics is that the average 5-star rated mutual fund will become a 3-star mutual fund over the course of a 3-year window, which means that when you just look at performance alone, it's hard for strategies like mutual funds or ETFs to do that over time. And so what we've learned in the institutional space is that deeper analytics are needed. At Helios, we recognize that holdings are an important piece, but they're just one piece of a much larger and complex puzzle. And if, again, we bring this institutional process into place, we have a systematized way of looking at analytics called HWAR. Stands for Helios Wins Above Replacement. If you like baseball, we completely and totally stole that term from the baseball world. But it's our world-class way of looking at holdings, analysis, selection, and documentation. Now, I'm not going to bore you with a deep dive review of this, but what it is it's about a 9-page analysis looking at mutual funds and ETFs as an example in all the different ways possible to understand a few different things. Now, you may end up seeing some of these reports as you're working with, your advisor at Hilltop. You might not. This might just be all in the background, but I at least wanted to share with you some of the analytics that are within reach for the investment committee to go ahead and use to make sure that there's an alignment with the holdings that are going into your portfolio. Let me walk you through a little bit about this. You might hear a mutual fund or an ETF get an HWAR score. Our scoring system goes from 5 to -5. 0 is the average for that asset class. So any number above 0 is above average. Makes it pretty easy. What you'll find is that we do everything based on a peer group ranking. And the reason we do this is because we're a statistics company, ultimately. We look for probabilities. And what we find is that the higher we can rank a strategy versus its peer group, the more comfortable we are that over the course of the next year, it will be able to maintain or improve its risk-adjusted returns. To do that, we have 2 types of main analysis. The first is what we call appeal. This is the performance and results, historically speaking, relative to its peer group. So how did it do in terms of returns? On a risk-adjusted basis is essentially the nuts and bolts of that calculation. But the second score we give is one called experience. And this looks at the behavior and characteristics of a strategy. In other words, it's interested in determining what is the likelihood that it can continue to be a top-rated strategy. The first calculation appeal is about the past. The second is more or less about the future. Let me give you an example of this for those of you that are just as nerdy as I am. On the left is one chart that's part of our appeal calculation. This shows the consistency of alpha in that strategy. Alpha means outperformance. So this strategy is shown to be showing alpha 92% of the time over the course of the last 3 years. Now, as you can tell by the dates there, it didn't do so well during the COVID-19 crisis. But I put this one up here on purpose because it shows a yin and a yang a little bit. But the point is spending 92% of its time in the last 3 years in an alpha positive position. That's really good. That's nice. That's when you look at your returns and you're like, wow, that looks good. But like all things in life, there's always a price. To swing for the fences and have great appeal in terms of returns, normally you have to give up something like experience. There has to be some scary moments. So in this example here on the right, you can see that if we did a return analysis as of 8/30 of 2020, the benchmark in gray would have been at 22.5%, but this strategy would have only been at 14%, or roughly an 8.5% difference in performance. That's a big number. Now, if I were to go ahead and say, well, let's not have a big difference between benchmark and strategy returns, let's make the experience better, well, then you might guess that the appeal numbers go down as well. So one of the major reasons that I'm showing you this, and the reason that we deploy this type of calculation to decide what holdings would go in a portfolio, is there's always a trade-off between the appeal or returns and the consistency or experience. And that's just like anything else in life. We want to quantify that, and we want to make sure that's aligned with the goals of the management team at Hilltop. So this is just a small glimpse of the type of analytics that we deploy at very, very tiny levels to make sure that Helios helps align the philosophy of a strategy that's underpinning a model that might be in your portfolio with the actual pieces and parts that are controlling the consistency of returns over time. So I think I just said a lot of million-dollar words there, but the main thing I really want to point out is that holdings analysis is not something that we pass by, that we do a lot of work here to make sure that there's an alignment. Because most of everything in investing is about perspective. And if you're philosophically aligned with your perspective when it comes to your holdings, there's not so many surprises. There's not so many of those shocking moments. And that's something that obviously makes for a better experience overall. All right. That one's hopefully a little bit intuitive, but happy to answer questions on that as we go forward here. Looks like there is one question. Let's see if it's one I can answer in line here. Question along the way, Steve asked, how do you know if the fund you are reviewing doesn't change their investment strategy or portfolio mix, impacting the future expectations of performance? It's a great question. Number one, every mutual fund or ETF is governed by a prospectus. And so they would have to go through a prospectus change in order to materially materially deviate from what they have stated their goal is. So if they say that they're a large cap value strategy, that's fantastic. They have to stay a large cap value strategy unless they change their prospectus. If they change their prospectus, our data systems capture that and they would be recategorized to whatever they've changed themselves to be. So that's the number one big one that would be caught. Certainly a strategy might change a little bit internally, staying within the same peer group. And if they make a strategy change for the good, we'll capture that and rank them against their peer group in that way. If they make a strategy change, but it ends up giving them poorer experience or appeal type data, then we'll of course capture that as well. But if anything materially happens, we would be able to track that pretty quickly. Hopefully that makes sense. All right, let's jump back into our second layer of risk management. So first layer of risk management, all about making sure that we believe in the philosophy and the execution of the various holdings that we've selected. When it comes to the second layer of risk management, it's all about a quantitative process. And I'll go ahead and do a little bit of an example here. But this is where we get into this unemotional approach to making decisions. And as I alluded to a minute ago, Helios is ultimately a statistics company. We take in vast amounts of data, we determine the statistical relevance of that data, and then use that to make a decision. And as you might expect, the more and more decisions you make, the more likely the statistics are to bear out. Let me give you an example of this. If I gave you a coin and I said flip it 10 times, you might flip 8 heads. Now you know that over time, if I kept flipping that coin, I would not consistently get 80% heads. Eventually, I would get 50% heads and 50% tails. In the long run, the statistics bear out. In the short run, you can get anomalies. You could get 80% heads. But in your mind, you know that if you keep flipping it, you'll eventually get 50% heads and 50% tails. Believe it or not, that's very, very similar to the world of asset management. The more and more you make statistically probabilistic decisions over time, the more and more those statistics bear out. Yes, you go through certain years or even sometimes even 3-year periods where instead of getting 50% heads, you get 80% heads and the statistics are not bearing out. But the more and more you do it, the more and more it happens. Same exact way of thinking about a casino. You might walk into a casino and you might win big one night, but if you go back to that casino every single night, eventually the house will take your money. Again, it's all just statistics. So that all makes sense in terms of analogies, but let me show you a little bit about what that means in our world. So for us, every single quantitative process begins at the individual data point level. Now, the words are really small on your screen, but what you're looking at is a three-step process as it relates to the ISM non-manufacturing index. It's one of the more well-known economic data points. And I should preface this is an economic example from a calculation. And now what we do through a quantitative process that we deploy against a single data point is we're basically taking oranges and bananas and limes, all these different types of fruit, and converting them all into apples so that we can make apples to apples comparisons, right? So we're going to go through a process of taking in all the data around this ISM non-manufacturing index. We're going to then transform that data into something that's more like an apple. And then we're going to use that one single piece of data as if it was its own model to see if it's relevant in helping us make decisions now that it's, comparable apples to apples. Once we've done that for one data point, we will deploy that across many, many thousands of data points. Now, generally speaking, when we're providing this type of research, like you see on these pages here to Hilltop, we do it in heat maps because you can visualize data through heat maps instead of looking at a gigantic numbers grid. And this is an example of some of the research we provide every single month to help them make statistical decisions. So once we've deployed this across many thousands of pieces of data, now we can start doing some probability analytics. So what we'll do is we'll roll up those many thousands of data points into roughly 220 economic signals. We then will group those 220 signals into 12 buckets, or what we call indicators. These buckets are all well-known words to you if you watch CNBC. They are groups such as labor, consumer sentiment, productivity, words like that. And those 12 indicators come together to create a single score for the economy. And that score goes from 0 to 100. So effectively, what we're saying when we're doing a statistical analysis of the economy is rolling up many, many thousands of pieces of data to create a single score. And right now, we score the economy about a 40 out of 100. So the question is, statistically speaking, when the score of the economy is 40, how likely is sustained and deep volatility in the marketplace? If there's a very low probability that we're going to get sustained and deep vol, then we can step on the gas. We can overweight equities. We can make hay while the sun shines. If it's kind of a wishy-washy level of probability, maybe we're neutral, right? And if there's an extremely high likelihood that there could be sustained and deep volatility in the market, those are the times when we pull back the reins, add some defensive measures to the portfolio, let that statistical risk go by us, and then get back on that gas pedal and make hay while the sun shines again. This is just one example of some of the data analytics, this one specifically around economics, that we're doing day by day, minute by minute, and communicating over to Eric and his team. So as they're looking at your portfolio, they can have a nice backbone of information to decide whether or not, risk on or risk off for you as an example. In short, Helios is the only customized and flexible model ecosystem available to financial advisors. And like I said, we're thrilled to be partnering for all these years with Eric and to make sure that we're deploying that capability for you. All right. So the first two, I think, are pretty intuitive, right? When it comes to selecting holdings, such as mutual funds or ETFs, we want to make sure that they align with the philosophy of you as a client and your advisory team. And we have a very powerful quantitative way of not only selecting and documenting those funds. Those funds will then go into the models that are based on a quantitative process, whether it's economics, such as the example I showed you, whether it is volatility-based, whether it's trend-based, whether it's contrarian. All different types of models can be used based upon your individual situation, your risk tolerance, and of course, your goals in the future. But all of that comes together in the third layer. And the third layer is what we call diversification of mathematics. It's our goal to help Eric and his team build what we call a confidence circle. And the easiest way to understand the idea behind portfolio construction and a confidence circle is this picture. Now, if I'm an engineer and I'm going to build a car, I have one job. That one job is that if that car gets into an accident, the passengers have to walk away with the same life after the accident as they do before the accident. And how this is accomplished is through the use of something called a crumple zone, a part of the car that's designed to take damage, to take a dent, so that the rest of the car stays intact. So if I were to make a graphic out of this, I would make it look like this. I have my car, and the arrows are all the potential places that danger could come from. So if I know that danger can come from all these different directions, I can put crumple zones all around my car to make sure that my goal, that the passengers have the same life after the accident as they did before. So if I have danger that comes from the front, good news is I have a crumple zone there, and the odds of my passengers walking away without a scratch definitively go up. Let's take this exact same set of graphics and let's apply it to an investment portfolio. Because we have done a good job of understanding the holdings that go into a portfolio and understand what various models there might be, looking at different data sets, we don't have this problem. The problem that most investors have with their portfolio is it's all based around one set of mathematics. And in most cases, it's 100%, let's say, modern portfolio theory. But it doesn't have to be modern portfolio theory. It could be all trend. It could be all value. It could, any one mathematic approach can only look in one mathematic direction. And so if I can only look in one mathematic direction, in this example, modern portfolio theory is very, very good at defeating whiplash risk because it really doesn't change. It kind of sits there at a prescribed level of risk and does what it does no matter what goes on in markets. So in a high whiplash type of a market like 2020 was, it did really well. In fact, there was a kind of a crumple zone waiting for it. That portfolio took a dent in March, but the financial plan was the same after the crisis as it was before. Modern portfolio theory in 2020 did its job, which is fantastic. But that's not what happened in 2008, and that's not what happened in 2000. In fact, in both of those scenarios, if we did nothing, if we just let the portfolio sit there, it took years to get back to even, right? And because time is ultimately the most precious thing that we all have, the financial plans were permanently altered in many cases. Some lucky folks, that wasn't the case, but in many cases, a complete reevaluation of the future was needed. Either people had to work longer or they weren't able to retire with the same desires they had previously. The reality of it is that no one knows what the next crisis is going to look like. We have no idea, literally zero. No, that's what makes a crisis, is no one ever sees it coming, right? And so we had to build our research and analytics to support a process that can help defeat something that's entirely unknown. At the end of the day, as mentioned, nothing can prevent periods from underperformance. There is zero investment strategies that have ever existed in the future in the history of mankind that have not gone through periods of underperformance. But we believe very deeply that mathematic diversity mitigates the impact of a market crisis. Let me show you what I mean by that. So here we are back again. We have these crises that we've experienced in the past, some of which are known, the future ones are unknown. And the question is, well, how do you build a portfolio made up of all these individual accounts that you have in a way that can prepare us so that we can't get wiped out by one scenario? And that's what Helios is built around. So part of your portfolio will have volatility, as an example, in it. Part of your portfolio will have economic data. Part of it might be more static. Part of it might be more trend-based. That way, through having all this different math built into one portfolio, we can do a better job of looking out in multiple directions. Now, you're not going to hear words like this. You're probably going to have model names that Eric and his team will share with you. And they might have funny names like managed risk or smart growth. But underneath these names are unique sets of mathematics. And by doing that, it's our industry's best attempt at building crumple zones around a portfolio. And the goal is exactly the same, that regardless of what type of crisis, what type of accident comes along, the financial plan needs to be the same after the crisis as before, creating a continuity and a confidence, if you will, that regardless of what crisis comes along, we're doing our mathematic best to make sure that it doesn't define our financial future. Nothing's perfect, of course, but that's the so what onto why, when it comes to institutional level portfolio management, that the endowments, the pension funds, the insurance companies, the high net worth people seem to always be just fine. And it's always the little guy, the normal retail investor that tends to struggle. And a big reason for that is a lot of what we've gone over today in the idea of mathematic diversity. So plainly put, our goal as a firm, and just kind of an introduction to the research and analytics we're doing behind the scenes, is to feed data and information to Eric and his team, their investment committee, to help maximize the probability of achieving the long-run plan, regardless of the crisis that comes along. So what I'll do is I'll leave this slide up. I do want to talk a little bit about what our data says right now. So I'll do that verbally without just killing you guys with slides. But I'll leave this up so you can just get a little bit of a sense of, again, these 3 layers of risk management that are critically important to us and really are the 3 major silos of research and analytics that we're pumping over to Eric and his team. So I don't see any questions in the chat, but I will pause here and take a sip of water in case Eric or anyone else, you want me to drill into anything else. But
Chris, I see a question here. It's a good one. How often do you update your clients, in this case, the Hilltop team, with this data?
Well, much to their chagrin, as often as we need to. So we're communicating a minimum of twice per week, which is part of our normal update process. But whenever we have something fast moving happen in the markets, we are going to be same day with that. Different models have different trade sensitivities. So some models might trade a little bit more frequently, others might trade very infrequently. It depends upon the tax status of that account, the overall goal and risk tolerance that you have and your advisor has allocated a model to. But we're constantly communicating with Eric and his team. And sometimes, in all fairness, that gets a bit annoying when we have fast moving markets and every day there's new research coming out from our shop. But I say that with a big smile on my face. But at the end of the day, we communicate as much as needed, but a minimum of twice a week.
And then another question, Chris, is do you factor in possible changes outside of the control, like tax increases to income, short gains, long-term capital gains, and do the models provide what-if scenarios on the confidence factor for success?
Good question. So let me chop those up into a couple different pieces. So when you think about tax increases, right? A tax increase in and of itself is not particularly interesting to us. What is interesting to us is how and where those tax increases impact, let's say, the economy, right? And that's where we track the data. So as we're seeing the real life manifestations of something like a tax increase, and maybe it's a pullback in consumer spending, maybe it's a lapse in business investment, we're able to then calculate how that, or how much that will matter, if you will, statistically speaking, to market performance in this case. So we're not going to track the exact fact that a tax increase happened, but we will track the ramifications of that because that's actual real life as opposed to speculation. So one example, I go on to lots of them, but hopefully that gives you the spirit of what I'm talking about. And then, do your models provide what-if scenarios or a confidence factor for success? Short answer is yes. So in every model that we run, there is essentially a range of possibilities. And so those possibility sets or confidence factors can roughly be described in standard deviations. So when a model is selected for a client, your advisor is going to be looking at that specific type of risk tolerance. The wider, let's just say, the confidence band would be, the more aggressive that strategy might be, and it might not be the right fit for someone. So we have models that have very tight ranges. We have models that have very wide ranges. And again, the advisor, knowing your specific situation as a client, will be able to mix and match or pick and choose what models are utilized to best fit your combination of risk tolerance that you want and growth that you need for the financial plan to come true. And of course, can switch those along the way as needed. So we have a wide spectrum of different models for different situations. Other questions? All right. If you'd like, Eric, I'll talk a little bit about what we see markets and economics right now and give you guys a little bit of a scoop for the rest of the year, if
that'd be great.
That'd be valuable. Cool.
That'd be great.
So let's talk a little bit about what we have right now. Right now, we have a very, very interesting situation where we have a lot of stimulus money in the system. Really, that started about a year ago, almost to the day. And we've seen regular disbursements of stimulus. Well, what does that mean exactly? Well, it means a couple different things. First of all, when stimulus money hits a bank account, generally speaking, it's going to benefit companies one way or the other. Either debt is going to be paid, which benefits the company. New things are going to be purchased, which benefits the company. Or that money will be saved. Generally, that means it will be invested in the stock market somehow, some way, and the valuations of companies then go up. So the stimulus packages that have all been deployed, that money tends to roll downhill into the stock market. And that's part of the reason why you saw such a massive jump in asset valuations, is because people were spending money with companies or they were investing in companies. And so we saw this rocket ship moment where the markets went from negative 30% to positive 30% kind of a thing, a big whiplash event. And the question is, what does that mean now that we've gone through all this stimulus for the next, let's say, 6 months to a year? Well, part of the package that quote unquote saved the economy was dropping interest rates to zero. Interest rates are used as a gas pedal and a brake pedal on the economy. So if interest rates go down, it incentivizes growth, so it's a gas pedal. If interest rates go up, it slows down growth, making it harder to do business, and therefore we end up with a scenario where, as you might imagine, the economy slows down, right? So once we have that basic understanding of interest rates as a gas pedal or brake pedal, generally interest rates will start to go up, right, as the economy gets hotter and hotter and hotter, right? And so does inflation. Inflation is basically supply and demand. When there is way more demand due to, in this case, stimulus money floating around, than there is supply, prices go up, right? And right now we have a bit of that effect going on. We have a lot of helicopter money that's come in, right? People are spending money, they're buying things, but the economy is still weakened, right? We don't have the same size economy that we did a year and a half ago. And so now you're noticing some empty shelves, right? There's a lot of demand for things, not a ton of supply, so prices have gone up. So in the short run, we're starting to see inflation. Now, it's not good if you see a lot of inflation, because if things get too expensive, people stop buying stuff, right? Consumption goes down and therefore our economy goes down. So the Fed normally, when it sees inflation going up, will raise interest rates, right? Because that acts as a brake pedal. So by raising interest rates, the economy slows down, inflation calms down, and we can have a normal level of interest rates and inflation, and life is great, right? Well, with the Fed artificially holding interest rates down at zero on the short end of the curve, and interest rates rising with the economy on the long end of the curve with inflation, you started to see choppiness in the market. You started people sell tech companies and sell growth-oriented companies where people have made a lot of money, and they've started buying assets like bonds, right? They're now paying more interest, right? The question is this volatility we're seeing in the markets because of rising long-run interest rates and rising inflation, is that real? Is that going to be around for a while? Or is that a blip? And right now, the data says that that sort of thing is a blip. That extra inflation, that demand that's coming in, is being largely driven by an externality, AKA helicopter money stimulus, right? And at the same point in time, artificially low interest rates. Well, the Fed has gone out and said, look, we're not raising rates for a while, right? In their communications, it's been 2023 and beyond, right? So, and we're in 2021 right now. So that's a long time of keeping rates very, very accommodative, right? But yet we've seen long-run interest rates spike up. And if you have bonds in your portfolios, folks, you probably notice there's been some price volatility there. Well, ultimately, what we expect to have happen is for interest rates to mean revert. Interest rates right now are more than 2 standard deviations away from their normal pattern. And so we do expect them to come back in line with their normal relationship to itself. That's the first thing. The second thing is that the inflation fears are largely going to subside as that stimulus money rolls through the economy. It does what it does, and then no longer is that extra layer of demand there due to extra wealth in the system. The question is, well, how much has that mattered, right? How much did this stimulus matter to this consumption problem that we're seeing and the rise in markets? And just to put it in perspective, we as an industry have been tracking household income growth month over month since 1959. In April of 2020 was the single largest increase in household wealth ever recorded since 1959. It was a massive amount of money. And we're going to see another piece of data like that probably next month when we look at this latest stimulus package that's been sent out as well. That household wealth will have increased on a month-over-month basis. That'll probably be the new record, will be March of 2021, taking over from April of 2020. These are big, 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 big time dollars that we're seeing here that are being pushed around. So my message to you right now is that we do expect these inflation concerns to go away. We do expect long-run interest rates to come down. And we expect the markets to melt upwards here over the course of the remainder of the year. I do not expect the Fed to start talking about raising interest rates until probably late next year. I don't think they're going to be able to hang on to 2023. I think inflation is going to be a little bit more stubborn than they expected it to be. And they'll have to raise short-term rates at probably late next year would be my guess at this point, just looking at the tracking of data as we see it at the moment. But again, the Fed has been projecting very long-run accommodative policy to the to make sure that there's a confidence in investing in the markets and making business improvements and so on and so forth down the line. So that's piece number one. Piece number two is we don't really expect to get really core solid economic data until about Q4, maybe Q1. So right now we still have a lot of externalities. We still have some states that are not fully open. We still have not everyone has achieved herd immunity when it comes to the coronavirus. And so we don't expect to have a full quarter of data until probably Q1, which means all of Q4 would be normal this year. There's an outside chance that all of Q3 would be normal, and therefore we would get one full quarter's worth of data as we get into Q4 from Q3. But that's not the high probability event. The high probability event is at some point in time in Q3, the world will be open. That means we'll get a full Q4 of normal economic data. And then in Q1 of next year, we'll be able to say, okay, let's level set here and see really where the economy is sitting, because all the externalities of stimulus and shutdowns will have largely washed away at that point in time. So we still have a ways to go. We're going to have a lot of choppiness in the markets over the course of the year. On average, we tend to get about 1.5 corrections per year, which means at least a 10% loss in the market from an all-time high. It wouldn't be out of the question to get 2 this year. We already had 1 correction in the NASDAQ just a few weeks ago. But we're largely recovered from that. So a lot of choppiness would be my expectation here over the course of the next 6 months to a year. But I do expect the economy to normalize from this point, especially with the kind of do whatever it takes attitude coming out of the Fed. That gives the market a lot of confidence to reinvest.
Thanks, Chris. A couple other questions I think I can take this as well. So has Hilltop begun making portfolio changes based on the models? And should we expect to see more rebalancing occurring in varying intervals going forward to our portfolios? So the answer is we have begun making changes in qualified assets, IRAs, Roths, and depending on your model and your risk tolerance and the dollar amount in each of those type of accounts, we have made some changes in those accounts, and so we've integrated those. And yes, with the Helios models and the data that they provide, there will be various changes. So your advisor can review with you where you stand as it relates to the model and your risk tolerance, and actually based on the model and how it's built, how much equity it could have and how minimal equity it could have. And so they can share more details for your particular situation. I will say that there will also be some continuous just adjustments in the portfolios over the next several months. And one of those being that we have in the portfolios, many of you may own some real estate that is not as liquid as mutual funds and ETFs, and we can only liquidate those over a period of time. And so we'll work at doing that. The reason why it's only been in IRAs and not in just standard brokerage accounts is because of the tax consequences. So we will work through individually with clients and determine what tax consequences, if any, there will be. We don't want to make major changes and cause tax consequences that are unneeded. So that's that part of it. Chris, I don't know if you wanted to comment any more on that, but we do rebalance as we get the data, and that's part of the mathematical process.
Yeah, I mean, to kind of allay any fears, we want a nice balance of analytics and trading activity. And so we don't expect to be trading very frequently in any of our models, maybe 3, 4, 5 times per year. So you should notice a similar level of trading activity as you're always used to. The rare exception to that would be major displacements in the market. And if we need to trade a little bit more frequently during those isolated periods of time, we certainly will. But the goal of all of our modeling is to be very friendly to your experience. And we know that too much trading doesn't provide a very good experience. So 3 or 4 times a year, that's generally our goal with each model. And that was the expectations I would set with you.
Great, thanks. And then another question is, do we have an example to demonstrate what Hilltop will create as a portfolio recommendation? Certainly we do. So these models are built, and your advisor can work with you individually and obviously show you that, and you see it on the Hilltop portal as well and how it's broken down. And we can do comparisons. So we can look at whatever the model is, and we can look at historical data just like any other model. That's that's a standard that we had done before, and we obviously have that capability moving forward. Great. Chris, all right. So any closing thoughts?
No, I mean, other than the fact that super excited to be partnered with you and your team. A lot of this information is new, some new vocabulary words maybe, but I think the major key theme here is that we are we're very, very detail-oriented company. We believe in high-quality analytics to help you and your team make some good decisions. As mentioned at the very top, your advisor still maintains total and complete control of your portfolio. There is no risk whatsoever that Helios will decide to do something and that's going to affect you somehow. We interface directly with Eric's investment committee to make sure that they're up to speed on any topic that would be material to you. So from your perspective as a client, pretty much nothing's really going to change. This is just a little peek behind the curtains and some of the ways that that we're supporting them from a data and analytics perspective. So,
okay, great, Chris. Thanks so much for joining us. I just a couple things as we close out, so you can get on with your evening. I first want to thank you for the entire Hilltop team. We want to thank you for being a client and trusting in us and guiding you along your financial journey. We take it very, very seriously, and we know Helios takes it serious in providing us all of the data to make sure we can really put together good quality portfolios, and appreciate that as well. As you have your meetings with your advisors coming up, I know many of us have been talking to clients a lot anyway, but as they are coming up, we're certainly going to review these and answer any questions. If you do have any questions, obviously you can always reach out, and we can chat about it and answer any of those other questions that may come up. So with that, I'm going to close out. Thanks again, Chris, for the opportunity as well as partnering with us. And I think we are done for now. Thanks so much, and everyone have a great evening. Bye-bye now.